written records that convey the business activities and the financial problems of a company. What is the benefits of financial statements? The benefits of financial statements is first, help decision making. Financial statements consist of valuable financial data, company information that helps in decision making. The proper analysis helps the company in identifying the company's weaknesses and strengths. Therefore, these documents can companies prepare to as the basis for stakeholders in making decisions related to business operation. Second, assist with report generation. The financial statements include an income statement, a balance sheet that represent the company's historical financial performance during the period. You can use the financial information to report the shareholders, creditors, managers, and other stakeholders to know the company's financial conditions. Third, health and pure casting. These documents also has a vital role in providing pure cast for future financial actions. Companies prepare financial statements to give estimates of future expenses, income, investment, and financing.
The importance, types, and example of financial statements, which are: first, the income statement. The income statement makes public the results of a company business operations for a particular quarter of a year. Second, how to prepare income statement. To prepare an income statement, you will need to generate a trial balance report. Calculate your revenue, determine the cost of the goods sold. Calculate the gross margin, include operating expenses. Calculate your income, include income taxes. Calculate net income and second is balance sheet. What is balance sheet? A balance sheet is calculated by subtracting all of the company's liabilities and shareholders' equity from its total assets. How to prepare balance sheet? Most balance sheets are arranged according to this equation. Asset equals liability plus shareholders' equity. Determine the reporting date and period. Most companies, especially publicity, trade ones, will report on a quarterly basis. When this is the case, the reporting date will most usually fall on the final day of the quarter. From current assets, we have cash and cash equivalents, short-term marketable securities, account receivable, inventory, and other current assets. And from non-current assets, we have long-term marketable securities, property, goodwill, intangible assets, other non-current assets. Current liabilities have account payable, accrued expenses, deferred revenue, current portion of long-term debt, other current liabilities. From non-current liabilities, we have deferred revenue from non-current, long-term lease obligations, long-term debt, other non-current liabilities. Calculate shareholders' equity. If add total liabilities to total shareholders' equity and compare to assets. What is the statement of cash flows? A cash flow statement is a financial report that details how entered and left a business during a reporting period. How to create statement for cash flows? Number 1, determine the starting balance. Number 2, calculate cash flow from operating activities. Direct method and indirect method. Calculate cash flow from investing activities. After calculating cash flow from operating activities, you need to calculate cash flow from investing activities. Calculate cash flow from financing activities. Cash flows associated with raising cash and paying back debt to investors and creditors. Number 5. Determine the ending balance. Finally, one cash flows for 3 main types of business activities are counted for. You can determine the ending balance of cash and cash equivalents at the close of the reporting period.
Statements of shareholders' equity. Shareholders' equity is determined by calculating the difference between a company's total assets and total liabilities. The statement of shareholders' equity highlights the business activities that contribute to whether the value of shareholders' equity goes up or down. Example, common stock, additional paid-in capital, preferred stock, retained earnings, and the accumulate other comprehensive income. Advantage of financial statements. Financial statements are useful for the following reason. First, to determine the ability of a business to generate cash and the sources and uses of that cash. Second, to determine whether a business has the capability to pay back its debts. Third, to track financial results on a trend line to spot any looming profitability issues. And fourth, to derive financial ratios from the statements that can indicate the conditions of the business. And five, to investigate the details of certain business transactions as outlined in the disclosure that accompany that statement. And six, to use as the basis for an annual report which is distributed to a company's investors and investment community.
The disadvantage of financial statements. There are few downstairs to issuing financial statements. A possible concern is that they can be manipulated, leading investors to believe that the issuing entity has produced better results than was really the case. Such as manipulation can also lead a lender to issue debt to the business that cannot realistically repay it. To prepare an income statement, you will need to generate a trial balance report. Calculate your revenue, determine the cost of the goods sold. Calculate the gross margin, include operating expenses. Calculate your income, include income taxes. Calculate net income and lastly, finalize your income statement with the business details and the reporting period.